Welcome to this deep dive into the first quarter 2025 earnings call for Manhattan Associates. We're here to cut through the jargon and really get you the core insights.
Yeah, absolutely. We want to look at how they're performing, what their leadership is actually telling us.
And right off the bat, it sounds like a pretty decent quarter for them.
It was, yeah. Manhattan Associates came out stronger than anticipated for Q1 2025. They actually beat expectations, top and bottom line.
Okay, beat expectations. So let's unpack that. What are the headline numbers that really jump out?
Well, the really big one, I think, is the cloud revenue. That saw 21% year-over-year growth. That's clearly a major engine for them.
21%. Wow.
Yeah. And beyond that, their remaining performance obligation, that's the RPO, that saw a really substantial increase, 25% compared to last year,
Right.
hitting approximately $1.9 billion. And we also saw a notable expansion in their adjusted operating margin.
So strong cloud growth, that healthy future revenue pipeline with the RPO seems like a pretty solid foundation. What about profitability? How do they do there?
Well, their adjusted earnings per share, that reached $1.19,
Okay.
which is a 16% increase from the same time last year. And like I said, better than analysts were expecting.
Right.
It is worth noting, though, their GAAP earnings per share, that actually saw a slight dip, down 1% to 0.05 cents.
Interesting. So the adjusted figures look really strong, but a bit of a divergence with GAAP. Any immediate reason why?
They didn't specifically dig into the GAAP EPS decrease right in their opening statements, but yeah, the overall positive adjusted results really suggest that underlying profitability is strong, especially, driven by that robust cloud segment.
Right. Okay, let's dig a little deeper then. Where's the money actually coming from? We've touched on cloud and overall revenue. What about the other parts?
So total revenue for the quarter was $263 million. That's a 3% increase year over year.
Okay, just 3% total. So cloud's doing the heavy lifting there.
Exactly. While cloud's the standout, their services revenue did see an 8% decline. It landed at $121 million. But interestingly, this was actually a slightly better result than the company itself had forecast.
Okay, so services dipped, but not as much as feared. What was the reasoning there? Customers pulling back?
The explanation they gave was primarily around customers adjusting their budgets, pushing some service work into later periods.
Timing, basically.
Right. Management was pretty careful to point out that at this stage, they haven't seen any significant negative effects from the broader economy beyond what they'd already flagged.
Okay.
But, they are keeping a degree of caution, let's say, about near-term services revenue growth, just given the nature of those time and materials contracts and the ongoing uncertainty out there.
Yeah, that makes sense. Companies maybe being a bit more strategic about when they pull the trigger on services work. Okay, let's circle back to that RPO figure you mentioned. $1.9 billion, up 25%. That sounds significant. Why is that such a key metric?
Well, you can think of RPO as basically the backlog for a subscription business like this.
Right.
So this $1.9 billion, it isn't revenue they've booked yet, but it is contracted future revenue. So seeing it jump 25% year over year and 6% just since last quarter. It strongly indicates healthy demand for what Manhattan Associates is offering. And it gives you a pretty significant degree of confidence in their revenue generation for the next few years.
So a really good forward-looking indicator.
Exactly. Suggests their sales efforts are paying off, translating into future earnings, and the average length of these contracts is still, pretty long, about 5.5 to 6 years.
Okay.
Although they did mention some customers are opting for maybe slightly longer implementation timelines on some of the bigger deals.
Gotcha. Okay, so a good predictor of future health. What about efficiency?
Yeah.
How well are they operating? You mentioned the margin earlier.
Yeah, the adjusted operating profit came in at $91 million, and that translates to an adjusted operating margin of 34.7%.
34.7%. That's quite high.
It is, and it's a considerable expansion, over 340 basis points compared to the same quarter last year.
Oh.
And this improvement, it's largely down to, the strong performance of that higher margin cloud revenue, like we talked about, and the operating leverage they're getting as that part of the business scales up.
Meaning costs aren't rising as fast as cloud revenue.
Precisely. So their costs aren't keeping pace with the cloud revenue growth, which leads to, greater profitability.
That's a really, really healthy margin. It definitely sounds like that shift to the cloud model isn't just driving growth, it's really boosting their profitability too.
Yeah.
Any other key financial takeaways from the quarter?
Oh, absolutely. Their operating cash flow saw a significant jump, up 37% to $75 million, which results in a really robust 28% free cash flow margin and a 35% adjusted EBITDA margin. Deferred revenue also ticked up 12% to $298 million.
Okay.
And they finished the quarter in a, very strong financial position, $26 million in cash, and importantly, no debt on the balance sheet.
No debt. Always good to see.
Yeah. And one more thing, they executed $100 million in share buybacks during the quarter. And the board has already approved replenishing that authorization so they can buy back another $100 million worth of stock.
Okay, so returning capital to shareholders too.
Yeah.
Really solid financial picture all around then. Now let's shift gears a bit. What did the management team highlight? Strategically, how do they see the market?
Well, first off, they emphasized the smooth handover with their new CEO. And they really reiterated their confidence in their market position. They believe their platform's world-class, their unified cloud products are superior. And they pointed out that industry analysts recognize them as a leader across the whole supply chain commerce ecosystem, not just, one little piece of it.
Right, the whole shebang.
Exactly.
Okay.
And their core strategy. It remains focused on driving innovation organically, so from within, and sticking with their established capital allocation approach.
And are they optimistic about future growth? Still see a big market opportunity.
Oh, very much so. They project that their addressable market, the TAM, will keep expanding at a double-digit compound annual growth rate.
Double digits.
Yeah, for the next several years. And they are strategically investing in their products to try and capture an even bigger slice of that pie.
Makes sense. How are bookings looking? Are they winning new business?
They reported strong bookings in Q1, said it was driven by a healthy mix. So winning new customers, actually. About half of their new cloud bookings came from net new logos, companies that weren't clients before.
Okay, 50% new logos, that's strong.
Yeah, plus also cross-selling to current customers and migrating existing ones to their cloud platform. And their success rate when they're competing for deals, still high, around 70%.
70% win rate, wow.
Yeah, and their sales pipeline, the potential deals they're tracking, that looks solid too. New prospects make up about 35% of that demand.
So actively expanding the customer base. What about new products? Anything on that front?
They did launch a new solution. It's called Enterprise Promise and Fulfill. And it's specifically designed to optimize how businesses promise and fulfill orders in a B2B context. The idea is to give B2B customers more of that seamless, consumer-like experience.
Bringing the B2C feel to B2B. Interesting.
Exactly. And they also highlighted a really significant win with a luxury department store.
Oh, yeah.
Yeah, this store is going to be implementing a broad suite of their Manhattan Active Omni solutions, replacing multiple old legacy systems, order management, POS, CRM, even chatbots, all with Manhattan's unified cloud-native architecture.
That's a huge win, especially breaking into luxury retail like that. Shows the breadth of their platform.
Absolutely. A notable competitive victory there.
Any other innovations they're focusing on? Maybe AI?
Yes, definitely. Their AI-powered customer service bot, Manhattan Active Maven, that's seeing increased adoption. It's now handling both chat and email inquiries. And apparently successfully deflecting like 40% or more of customer service sessions, which is pretty significant.
40%, yeah, that frees up a lot of human agents.
For sure. And they're also continuously enhancing their Manhattan Assist features across the whole platform, including empowering customers to add their own documentation right into the system's knowledge base. Okay,
so making the AI tools more customizable too. It definitely sounds like AI is becoming a more integral part of their solutions. All right, so considering, the current economic climate, what's their outlook? What are they guiding for the rest of 2025?
Well, they reaffirmed their long-term financial goals. So aiming for sustainable double-digit revenue growth and keeping those operating margins in the top quartile compared to their peers.
Okay, steady as she goes on the long term.
Yeah. And for this year, the full year target for RPO remains in that range of $2.11 billion to $2.15 billion.
Wow.
And the full year total revenue target is still set at $1.06 billion to $1.07 billion.
Okay, so holding guidance there. What about Q2 specifically?
For the second quarter, they're projecting total revenue to be between $263 million and $265 million. So pretty much in line with Q1.
Got it. And what about profitability expectations as we move through the year? Did they maintain the margin guidance?
They did. They reiterated the full-year adjusted operating margin target with the midpoint at 33.25%.
33 and a quarter.
Yeah. They think quarterly adjusted operating margins will be around 33% for Q2 and Q3, and then dip slightly, maybe to about 32.5% in Q4.
Why the dip in Q4?
They attribute that to the typical peak seasonality you see in the retail sector.
Ah, right. Holiday season impacts.
Okay.
What about earnings per share?
That's where they actually raised the guidance. They've increased their full-year adjusted EPS guidance to a range of $4.54 to $4.64.
Okay. So despite the broader economic caution, they seem confident enough to bump up the profit expectations. That's interesting. And the revenue forecasts for the individual segments, cloud services.
Yeah, for the full year, they're still expecting cloud revenue between $405 million and $410 million, services revenue $494 million to $500 million, and maintenance revenue, that's the older stuff, $118 million to $120 million.
Ooh.
They're also projecting a tax rate around 21% and a diluted share count of about 61.5 million shares, though that share count assumes no more buybacks beyond what they've already done.
Right. So it seems like they're navigating things pretty well, all considered. Were there any particularly interesting nuggets that came out of the Q&A session with the analysts?
Yeah, a few things. Management team emphasized again that they view the sales pipeline as strong, and they didn't really see any major lumps and bumps, as they sometimes call it, across different products or industries in Q1.
Pretty balanced performance then.
Seems so.
Yeah.
They did mention that their investment focus is increasingly shifting towards sales and marketing efforts, trying to accelerate that growth trajectory.
Leaning into growth.
Yeah.
Makes sense.
They also noted that the different types of cloud bookings, migrations, cross-sells, new logos, the resilience there tends to kind of balance out over time. No single one is dramatically stronger than the others consistently. There was a question about RPO duration. That slight decrease in the percentage expected to turn into revenue in the next 2 years.
Yeah.
They said that's mostly due to those longer implementation timelines for some of the really big, complex global deals we talked about earlier.
Okay. So bigger deals just take longer to roll out.
Exactly. And importantly, they reaffirmed their 20% growth target for cloud subscriptions for this year and for next year as well.
Still targeting 20% cloud growth. Okay.
Yeah. And they emphasize that things like precise supply chain execution, really tight inventory management, that's becoming more and more critical for their customers right now, given the macro landscape.
Sure, you need that visibility and control.
Right. And they highlighted how the flexibility of their cloud solutions really helps in this kind of volatile environment. They also sounded pretty confident about closing the large deals currently in their pipeline. Said the pipeline for big deals looks stronger now compared to last year.
That's positive. What about that luxury department store deal? Any more color on that in the Q&A?
Just a little. They said that particular deal had a sales cycle of just over a year. And yeah, they faced competition from several other vendors. It marks their first really major wins, specifically in the point of sale, the POS segment, for luxury department stores. So a beachhead there.
Yeah, opens up a new avenue.
Definitely. They also mentioned spending enthusiasm seems relatively consistent across their regions, Americas, EMEA, APAC, though, there can always be quarterly fluctuations.
Right.
And one final point on FX, foreign exchange, they updated their projection. They now think the impact on the full year revenue guide will be less than a 1% tailwind. But they cautioned, that could still change depending on currency movements.
Okay, less of a boost from currency than maybe previously thought. Got it. So let's try and sort of wrap this up. We've seen strong cloud growth, that healthy RPO backlog, expanding margins, a significant new customer win. What are the key takeaways for someone tracking Manhattan Associates?
Well, I think first, the robust cloud revenue growth and those increasing operating margins, they really demonstrate that the strategic shift to cloud is working. It's gaining momentum. It's positively impacting the bottom line. That's clear.
Right.
Second, that substantial RPO growth, it just provides really strong visibility into future revenue, gives you confidence. Third, their proactive investments in sales and marketing. That suggests they're really looking to accelerate customer acquisition, penetrate their markets further.
Going for growth.
Yeah. Fourth, that luxury department store win, it really highlights how competitive and comprehensive their whole omnichannel platform is now.
Proves the concept in a tough market.
Exactly. Fifth, their ongoing development and use of AI features like Maven and Assist that could provide a really significant competitive advantage down the line.
Yeah, AI is becoming table stakes almost.
It feels like it. And finally, while reaffirming guidance is a sign of confidence, in their market position and the mission-critical nature of their stuff, their cautious comments about the macro environment and maybe near-term services revenue, that's definitely something to keep an eye on.
Right, that caution is still there.
It is. Oh, and the share repurchase program that signals management believes the stock's valuable and they're committed to returning capital.
Good summary. Okay, now for our favorite segment. Time for some outrageous but plausible trade ideas. Based on all this, what have you got for us? Remember, this is not financial advice, folks.
Okay, not financial advice, just some brainstorming. So, given Manhattan Associates' focus on making B2B fulfillment feel more like B2C with that new enterprise promise and fulfill product, and just the general trend towards needing faster, more trackable B2B delivery, here's an idea. Maybe look at companies specializing in like last mile B2B delivery and logistics optimization.
Not just consumer last mile, but B2B.
Exactly. As B2B supply chains get more complex, needing that consumer-like speed and agility, maybe there's significant demand growth coming for those specialized B2B logistics players, kind of mirroring what happened in consumer e-commerce. It's a bit out there, but plausible, right?
Interesting angle. The B2B side catching up to B2C expectations. I like it. Got another one.
Okay, outrageous idea number 2. Again, not financial advice. Manhattan highlighted how critical precise inventory management is, especially with potential tariffs, supply chain snarls.
Yeah, that came up a few times.
Right. And they partner with Google Cloud, so maybe explore companies providing really advanced inventory management solutions that heavily leverage AI and predictive analytics, particularly ones that integrate tightly with major cloud platforms like Google Cloud.
So AI-driven inventory optimization.
Yeah. If tariffs and disruptions stick around or get worse, businesses will likely pour money into tech that helps optimize inventory, predict issues, and cut costs. These AI inventory specialists could be prime beneficiaries. Just a thought experiment.
Another interesting thought experiment, connecting the dots between their focus and potential tech needs. Okay, well, that brings us towards the close of this deep dive into the Manhattan Associates Q1 2025 earnings call. We've definitely covered a lot of ground.
Yeah, financials, strategy, outlook, even some wild trade ideas. What were the key things that stood out to you from all that? Any particular areas you'll be watching closely next quarter?
For me, it's definitely going to be tracking that cloud revenue growth, making sure it stays around that 20% target they reiterated, and also watching the adoption and impact of those AI tools like Maven. Seems like a big part of their future story. As always, we absolutely encourage you to do your own thorough research and analysis. Remember, this discussion is just for informational purposes. It is definitely not financial advice.
Absolutely. Do your own homework.
Join us next time on Talk Tickers for another in-depth look at a crucial earnings report.